I think in terms of looking at commodity prices, we have to look at developed versus developing markets. Obviously, a lot of the demand for commodities is coming from China predominantly, but also from other developing markets. And I think developing countries are really taking on the mantle for driving global economic growth. That being said, I think developed countries are really starting to flag on that point. So I think we're stuck in this really low growth, low inflation, low rate environment for a long time, whatever sort of fiscal or monetary stimulus measures we get in the developed world. And I think that as developed country central banks are trying to back out of their accommodative monetary policy and normalize monetary policy, developing central banks are going to try to do the same. And I don't think any of them will be able to do that. So I think in China in particular, after the Party Congress, the PBOC will start to remove accommodation, and so will the government. The big concern there being over-leverage in the economy. And I think that that's a risky foray, really. I think they're going to have to deleverage, but they're going to have to go about it very carefully in terms of removing accommodation. And so the risk is that they'll remove accommodation, which will actually feed through into the economy with a real lag. And we'll get a sharper slowdown in China and a lot of other developing markets at the same time. And then we'll have less demand for commodities, which of course will reduce the prices. So I think that's a real risk. That's probably the biggest global risk in terms of growth that we're looking at.
So Megan, why do you think we're stuck in this low growth environment?
I think we're stuck in this low growth environment because of a lot of global drivers that are going to be the case for the next decade, probably. That includes an oversupply of a whole bunch of things, including debt, both public and private. We have an oversupply of regulation. We have an oversupply of cheap labor globally, which is keeping pressure off of wage inflation and therefore price inflation. And if you don't have wages growing significantly, you don't really have much growth in consumption, and so that keeps pressure off of GDP growth. But I also think we have persistently low productivity growth across the developed world. A piece of that is certainly measurement. We don't know how to measure everything, so the picture is probably not as bad as the official figures suggest. But that's only a piece of it. Fundamentally, I think we have had a lack of capital deepening in this recovery, and I don't see that changing anytime soon. I think one reason is that we have such cheap labor globally, and labor sort of is the new capital now. So instead of investing profits in capital expenditure or investment, we have companies just hiring a load of really cheap workers. So I don't see that changing. And fundamentally, we don't have a big boost in developed world labor supplies. So globally, we have this glut of labor all of a sudden, but that's mainly in emerging markets. And so as long as we're not boosting our labor supply in developed countries, we're not going to get a significant acceleration in growth in those countries. So again, most of global growth is going to come from the emerging markets. But overall, if you look at the aggregated figure for the entire globe, I think it's going to be persistently low in terms of global GDP growth.
Okay. And do you see any bright spots on the horizon?
Yeah, I think India is a real bright spot. I've been an India bull for a long time and have been disappointed by recent GDP figures. But I think the real story there is that we haven't seen investment come in, and that's because of over-leverage in banking and corporates. If they can address that issue, and it's not an easy issue to address by any stretch of the imagination, but if they can address that, then I think we could see GDP growth really come in India, and therefore demand for precious metals, particularly gold. So that might not happen in this economic cycle, but in the next one, I think we can be positive about that.